Welcome to Group Insurance Daily Pulse, your rapid-fire deep dive into the most critical shifts impacting the group benefits landscape. I'm Aria the Actuary, scrutinizing every basis point and regulatory ripple.
And I'm Dorian, the distribution expert, here to highlight the strategic opportunities and market innovations. Today, June 16, 2026, we've got a packed agenda, dissecting everything from projected cost spikes and AI integration to captive solutions and federal mandates. Let's not waste a second. First up, a seismic projection from PwC and a fascinating juxtaposition of challenges and technological responses. PwC's Medical Cost Trend 2027 report just dropped, projecting a 9% commercial medical cost trend for group plans in 2027. Aria, that's an upward restatement from 8.5% for 2026.
Key drivers: AI-enabled billing, a surging pharmacy spend, and No Surprises Act arbitration outcomes favoring providers. Specifically, GLP-1 prescriptions hit 3.5 million monthly fills in December 2025, doubling the volume from December 2024. And get this, a 2026 survey indicates 65% of employed adults would be more likely to use a GLP-1 if their employer covered part of the cost. Dorian, seismic is an understatement. A 9% trend is an absolute catastrophe for Group P&L. We're already operating on razor-thin underwriting margins. This isn't just about premium increases. It's about the fundamental solvency of some group blocks. Let's dissect those drivers. AI-enabled billing by providers is a significant systemic risk. It's not about efficiency for the system. It's revenue cycle optimization for providers, designed to maximize claims reimbursement and reduce denials. How are carriers already facing this 9% headwind supposed to combat that with their own AI? Is this an arms race where the house always loses?
But carriers are responding with their own AI. An Earnix report reveals over half, 55% of UK insurers have already integrated AI into core business functions like pricing, underwriting, claims, and customer engagement. And the value proposition is clear. Manulife was named the #1 life insurer for AI maturity for the second consecutive year in the 2026 Evident AI Index for Insurance. They expect to generate over $1 billion of enterprise value from AI by 2027, having achieved $300 million by year-end 2025. Allianz also ranked #1 overall in the Evident AI Index among 30 global insurers, boasting a 28% larger AI talent pool. This isn't just talk, it's tangible value generation.
Enterprise value is a broad term, Dorian. How much of that $1 billion is actual P&L impact from cost reduction versus revenue optimization that might be offset by increased market competition or adverse selection? My concern remains the net effect. When providers are deploying AI to extract maximum value and the No Surprises Act arbitration process is consistently favoring them, carriers are fighting an uphill battle. The 9% trend isn't just a number. It's a direct assault on our reserving methodology and capital requirements. How are we adjusting IBNR for GLP-1s, which have a completely different cost curve and persistency profile than traditional pharmaceuticals? What about the regulatory implications of AI in underwriting, algorithmic bias, data privacy concerns under GDPR or CCPA, and potential DOI scrutiny on pricing fairness? The talent gap highlighted by Allianz's 28% larger AI pool is also a massive implementation friction for smaller carriers. And let's not forget the immediate challenge of GLP-1 formulary management and prior authorization. If 65% of employees want it and costs are doubling annually, the demand pressure will be immense, potentially overriding clinical appropriateness and leading to massive spend without clear long-term health outcomes for all users. The risk of solvency pressure from a mismanaged GLP-1 portfolio is very real.
Aria, that's precisely why strategic AI integration for carriers is paramount for survival and market share. Employers are desperate for solutions to this 9% trend and the GLP-1 demand. Carriers leveraging AI for sophisticated PBM negotiations, predictive modeling for demand forecasting, and personalized care navigation aren't just cutting costs, they're offering a competitive advantage. The ability to model different GLP-1 coverage scenarios, balancing cost and employee demand, becomes a critical differentiator.
This isn't just about P&L. It's about sustainable growth and employee retention. An AI-driven claim system, for instance, can identify fraud and auto-adjudicate routine claims, directly impacting administrative expense ratios, which does improve P&L. Manulife and Alliance aren't just making noise. They're demonstrating that strategic AI investments can create significant operational efficiencies and enable more precise risk stratification and underwriting, leading to better-priced products and, ultimately, a more stable book of business. The market demands innovation, and those who deliver will capture it. The long-term ROI on these investments, while complex to measure, is in the ability to remain competitive and relevant in a rapidly evolving risk landscape. Competitive relevance without capital adequacy is a short-term win, Dorian, but I hear your points on the imperative for innovation. Moving from domestic cost pressures to global cost pressures, Marsh has just launched an innovative new offering. The Marsh Nexus Captive Solution is designed for multinational organizations with an employee benefit spend outside the U.S. exceeding $3 million annually. This is a direct response to Marsh's own Health Trends 2026 report, which indicated anticipated double-digit cost increases for health benefits across most global markets. Aria, this solution aims to help clients manage risks and costs associated with international employee benefits, operating through Marsh's Mangrove Protected Cell Company, domiciled in Washington, D.C. This signals a clear market demand for greater control and predictability. Control and predictability often translates to risk retention, Dorian, and that comes with significant actuarial and capital implications. Captives, even protected cell captives, are not a panacea. For multinational organizations, establishing and managing a captive demands substantial internal resources, deep actuarial expertise, and significant legal and compliance overhead across multiple jurisdictions. The D.C. domicile for Mangrove PCC, what are the specific regulatory advantages there versus, say, Bermuda or Vermont? How does the Washington, D.C. regulatory framework interact with the myriad of local country benefit regulations globally? This isn't just about U.S. ERISA. It's about local insurance laws in every country where benefits are provided. Compliance risk here is astronomical.
But Aria, the intent is clear: to provide greater transparency and potentially significant cost efficiencies. Employers are seeking to retain underwriting profit, gain investment income on reserves, and mitigate the traditional carrier profit margins embedded in fully insured global programs.
Empowering can also mean exposing, Dorian. Let's talk capital. Even with a protected cell, what are the minimum retention levels? What happens if claims exceed projections across multiple cells? Or if a catastrophic event impacts a significant portion of the global workforce? The employer, as the ultimate risk bearer within the captive structure, assumes direct solvency risk. Precisely, Aria. It's for sophisticated multinationals. This isn't a small employer solution. For those with over $3 million in international spend, Marsh Nexus offers a strategic tool. A high-stakes move, undoubtedly. The actuarial rigor required for success here cannot be overstated. Dorian, huge push for access immediately translates to massive cost increase for plan sponsors and carriers. Eliminating cost sharing for 6 annual visits will undoubtedly drive utilization, particularly in mental health, where demand already outstrips supply and stigma has historically suppressed access. Who bears this cost? For self-funded or ERISA plans, it's a direct P&L hit. For fully insured plans, it means substantial premium increases. How do carriers price for this immediate surge in morbidity risk? We're looking at significant adverse selection potential if plans are suddenly mandated to offer these services at no cost.
But the intent is to reduce long-term healthcare costs through increased preventative care and early intervention, Aria. This isn't just about immediate spend. It's a strategic investment in employee well-being and long-term health.
The long-term cost savings are speculative at best in the short to medium term, Dorian. The immediate cost surge is a certainty. Employers, especially self-funded ones, are P&L focused now. This federal mandate will necessitate substantial adjustments to plan designs, TPA agreements, and claims administration systems. While ERISA preemption means it would apply uniformly to self-funded plans, the administrative burden for compliance across millions of plan documents is immense. Furthermore, can the existing primary care and mental health infrastructure handle a sudden, mandated increase in utilization? we could see significant access issues, longer wait times, and potential quality control concerns if the provider network is not adequately prepared. This bill has the potential for significant unintended consequences, including a shift towards shopping for primary care and overutilization of low-value services, further straining the system. Let's not forget the regulatory compliance costs for carriers and employers, and the increased scrutiny from the DOL and DOI on adherence to these new mandates.
Aria, this is more than just a regulatory burden. It's a societal shift towards valuing preventative care and mental health. While initial costs may rise, the ROI on human capital is undeniable. Healthier, less stressed employees are more productive, have lower absenteeism, and are more likely to stay with their employer. Plans that embrace this will be seen as truly employee-centric, enhancing recruitment and retention in a competitive labor market. This bill addresses critical access barriers, particularly for mental health, where early intervention can prevent far more costly acute episodes. From a distribution perspective, carriers and brokers who can effectively communicate the long-term benefits and help employers navigate these changes will be invaluable. It simplifies benefits for employees by removing financial friction at the point of care for essential services, fostering better health engagement.
A noble goal, Dorian, but the path there is paved with actuarial challenges and significant financial implications for plan sponsors. The market will need to adapt rapidly. And that wraps up another dense, data-driven edition of Group Insurance Daily Pulse. From a 9% cost trend and AI's dual role to global captive solutions and federal benefit mandates, the group insurance landscape is in constant, rapid flux.
Indeed, the only constant is change, and staying ahead of these developments is key to strategic success. Thank you for joining us.
We'll be back tomorrow with more rapid-fire insights. Until then, keep those models updated.